All right, welcome to Talk Tickers. Today we're going to be digging into the latest earnings report from Ollie's bargain outlet. And let me tell you, the numbers are telling a couple of very different stories.
So let's just jump right in. The numbers hit pre-market, right? And the stock popped. But then, as the day went on, that initial excitement just fizzled out. So the big question we've all got to ask is, was this thing a bargain or was it a bull trap?
To figure that out, we have to start with the numbers. And right off the bat, you're going to see why the market was so torn on this one.
First up, the bottom line. Let's talk about profitability. Adjusted earnings per share, they came in at a solid $1.39. That's a beat, folks, even if it was just by a penny. So hey, so far so good, right?
Okay, now for the top line, the revenue. They pulled in $779.3 million for the quarter. Now that's up a really healthy 16.8% from last year. You can't argue with that kind of growth rate.
And this is a big one. Comparable store sales grew 3.6%. For anyone who follows retail, you know this is a super important metric. It's the health check for their existing stores, and it tells us they're getting more people in the door, and those people are spending more. That's exactly what you want to see.
Okay, and this slide right here, this is really the heart of the whole story. You've got a penny beat on earnings, great, but you've got a $4 million miss on revenue. So, what does that mean? It means they were more profitable than the street thought they'd be, but they sold a little less stuff. And for some investors, especially in retail, that top-line miss is a huge red flag. So you see this mixed bag of a report, and you'd probably expect management to sound a little, cautious on the call, but nope, that's not what happened at all. In fact, they came out swinging with a really bold new game plan for growth.
I mean, just listen to this quote from the CEO, Eric Valk. Confident in delivering consistent mid-teens EPS growth. They're not just talking about the next quarter. They're trying to signal that this is a whole new era for Ollie's. They feel like they're at a big turning point, and they're ready to put the pedal to the metal.
And here's how they're planning to do it. It's what they're calling their new growth algorithm. It's a four-part strategy, pretty straightforward. First, aggressive store growth. We're talking 10% a year. Second, keep the existing stores growing at about 2%. Third, ramp up the share buybacks. And what does that all add up to? Their big target, that mid-teens EPS growth. It's a clear roadmap and a pretty ambitious one. And look, they didn't just talk to talk, they backed it all up with some pretty solid guidance for the next fiscal year. They're looking at sales around $3 billion, hitting that 2% comp target, and delivering adjusted EPS somewhere between $4.40 and $4.50. You know, on paper, this all looks totally achievable.
So, okay, confident management, solid plan, looks good on paper. You'd think the stock would have just taken off, right? Well, not quite. The market's reaction was, let's just say, a little more complicated than that.
This timeline here tells the whole story. You see that big pop in the pre-market, but then a slow, steady bleed all day long, closing well off the highs. In trader talk, we call that a fade, and it's a really telling sign. It means the early buyers, the bulls, they got completely overwhelmed by sellers as the day went on. And just look at this volume. Over 3 million shares traded hands. That's almost triple the daily average. This wasn't some quiet disagreement in the market. This was a full-on battle between the bulls who were buying that management story and the bears who were clearly looking at something else entirely. So, what was that something else? What were the bears so laser-focused on? Well, to find that out, we've got to dig into the Q&A session from the earnings call, and that's where one key theme popped up as let's call it a yellow flag. And here it is. This was the big issue. Softer new store productivity. Management basically admitted that their brand new stores just aren't performing as well as they expected. Their whole soft opening strategy seems to be leading to a much slower ramp-up in sales. And when a huge piece of your growth algorithm is based on opening new stores, well, you can see why that's a major concern. Now look, to be fair, it wasn't all doom and gloom on the call. Not at all. There were actually a bunch of positive updates that really do support the long-term story here. They're getting great deals on inventory thanks to other retailers struggling, and they're expanding into new stuff like furniture that's doing really well. So there are definitely bright spots.
Okay, so let's put it all together. We've got a mixed report, we've got a super confident management team, and we've got a pretty skeptical market. So what's our final verdict? And maybe more importantly for you, how do you think about this stock now?
It always comes down to this, right? Is it an outperform, a market perform, or an underperform? Are we recommending you buy, sell, or just hold from here?
Our call on this is market perform. And here's the thinking. You've got this really compelling growth story from a management team that knows what they're doing. But, and it's a big but, it's getting dragged down by a very real execution risk. The plan looks great, but the market and, frankly, us, we need to see the results first before we're willing to give them full credit for it.
So with that in mind, our price target is $110. And for a potential trade idea, here's something to think about: a pair trade. You go long Ollies, but you short the broader retail ETF, which is XRT. Now, why would you do that? Well, over the last year, Ollies has actually underperformed the rest of the retail sector by a lot. The thesis here is, if they can just fix these new store productivity problems, that performance gap is going to close. And that's how this trade could really work out.
And as always, we have to say it, this is not financial advice. All the opinions we've talked about today are just for informational purposes.